Dear investors, greetings, and we are happy in just coming out of this presentation on the market update for January 2023. Let me share the screen. Yeah, domestic equity. The Sensex is at new peaks, but just 5% of the stocks are near all-time highs. In the sense, in the year 2020-22, so Sensex just touched its all-time high and was hovering at 62 and just came back to 59 kind of a level, but still only 5% of the stocks are near lifetime highs. As of December 2022, on January 2023 is concerned, so the domestic equity markets fell, right? Especially during the last week of January, it took a beating with the basic indices just falling down by just more than 2%. And probably there is a negativity which just came in the market because there was a short sell-off in Adani Group company shares and followed by the Hindenburg research report and close to just $51 billion of its market value was being lost by Adani Group in less than 2 trading days. And the domestic equity markets fell under review because I will not say just only because of Adani Group, the markets fell down. Even beyond that, there was a fear and the anxiety, mainly just because of the global recession and also just because of the budget, union budget, which is due by February 1st, 2023. If you remember, the 1st February 2023 budget is going to be the 10th and the complete budget for this particular government. So we need to wait and see by next year, as next year only the interim budget would come out. The market participants were literally worried as actually just the Indian government is borrowing in a bigger way and they expect that the borrowing will be much, much higher in the next fiscal. And so just before the budget, it all reacts. The United Nations reduced its prediction for India's growth by 20 base points to 5.8% for the calendar year 2023. And the reason that it's cited or lower investment and export growth due to the rising interest rates and also just there is a high possibility of having a global recession. And or equities expensive, others are as equities or at expensive level. And again, actually, just when you compare to the bond yields have gone up, which makes it as a compelling option to just invest in the long-term corporate bonds. And coming back to the statistics, maybe just the BSE Sensex, as on 27 January, was hovering at 59,330 level, which if you just look at the year till date for the 2023 is down by 2.5%. And again, actually, just go back to the global equity. Say just the US economy just grow and because that is slightly a different kind of thing, I would say. The US economy just grow more than expected in the fourth quarter of 2022. Literally, right, Fed is like so very confused between the devil in the deep sea, which is like inflation and the recession. And so just if you look at the last quarter, probably just let me not talk about the last quarter. If you just look at there is a last quarter of say 2022, right? So just the probably just US grew a bit, and maybe just it is majorly because of the durable goods orders and personal income and a new home sales, which all just contributed is what I would say. Maybe US real gross domestic product, the GDP, rose by 2.9% in the fourth quarter. And maybe just if you go back to the previous quarter, it was 3.2%. It has slightly just fallen is what I would say. And coming back to another important stats, US credit card debt rose 15% to all-time high of $930 billion. Wells Fargo mortgage business drops by 90%. 37% of small business in US is unable to pay rent is what we hear. And hereby we have shown a chart which is how actually this Indian consumer price inflation is pairing vis-a-vis the US consumer price inflation. So look at the figures. The blue one is connotes the Indian CPI versus the darker one, which connotes the US CPI. So just we are far better in terms of inflation is what we are trying to tell you these are. And again, just coming back to the global indices across the globe, probably the year till date in the year 2023, it's all been quite positive. Maybe just you leave the last 1 week, which was like a mixed bag. And again, coming back to the Europe, when you talk about the global equities, European equity markets mostly rose as the market sentiments were boosted following an improvement in the German business sentiment, right? Actually, just because of the manufacturing activity, which is just which got picked up. However, the massive layoffs that's been announced by the tech companies probably just throw some kind of negative sentiment in the markets, right? And the market participants are very, very keen, and everybody is this closely watching the global markets at this hour as what is that US is going to dictate at this hour, and what's the Fed meet going to announce, and the European Central Bank, is there going to be any maybe just is there going to be a rate stability or a rate hike, and all those things are there. All those are the market expectations. UK inflation rose a 41-year high at 11.1%, and millions forced to skip meals as UK's cost of living crisis deepens. And nearly half of UK families are left with less than €3 a week, is what we hear. And UK restaurants going bankrupt at a faster rate than during COVID is like a slightly an alarming kind of a thing, I would say. And coming back to the Asian equity markets, right, they all rose positive. Actually, just as US markets went up in the final quarter, that is in the last quarter a bit. And actually, there is an expectation that US Fed Reserve will slow down the phase of rate hikes. Mainly because of that, actually, just the Asian markets grew. And this is yet another important or the interesting slide, I would say, because it's a update on China. So China is becoming less transparent about its economic performance and quietly discontinuing thousands of statistical series. Maybe just this is just to get you an idea. The transparency is literally just going out of Chinese, and I'll not say Chinese, out of Chinese government. And BlackRock exits actually just, and Tiger Global passes investments in Chinese equities. And coming back to the domestic debt, which is like one of the very interesting avenue these are to the investors. Yield on the 10-year benchmark paper, right? It rose by 4 bips in the last week of January, and it is sailing at 7.39%. RBI also conducted a couple of sovereign green bonds, right? Actually, just and it all got fully subscribed, and the yields are just roughly just hovering at 7.1 to 7.29%, and which makes it even more interesting. You look at the slide which talks about the government security yield vis-a-vis the corporate yield, which are like neck to neck, and which makes it as a compelling option for you to just invest in a dynamic bond kind of a fund, which could allocate to government security as well as to corporate bonds. Coming back to global debt, the US Treasury prices fell on fears that the US economy may soon get into a recession, right? So all eyes are on for the Fed policy by by 5th of that is 1st of January. There can be a marginal rate hike is what everybody feels. So what the latest news then? So when you come back to just India, maybe the mutual fund companies have been instructed by AMFI, which is the which is Association of Mutual Funds of India, which governs the ethical practices of mutual funds in India. They just ask the fund houses to change the settlement cycles from T+3 to T+2 from February 1st. That is, the transaction day plus 3 days was the normal, and they made a change. They brought it down to transaction plus 2 days. This happened after the equity market settlement cycle was changed to T+1 settlement cycle. So this is one main change. That means you will end up getting the redemptions much, much faster. According to just RBI Executive Director, the digital currency will support the digital economy even more and improve the payment systems, lower the cost of managing the physical cash, and in turn, it will just end up promoting the financial inclusion is what the RBI strongly feels. Despite the global recession, intense inflationary pressure and oversupply of many commodities, exports of goods are currently just reporting the excellent growth in India. This is yet another important slide to see that investors are overweight on cash and underweight on equities due to market uncertainties. right? So just this particular picture says, right, the cash component is much higher vis-a-vis the equity component, which has just gone down. You look at actually the alternate investments, which are slightly just higher, but actually just coming to the commodities and real estates have taken a beating. Bonds have also just taken a beating as people are hoping for some more rate hikes and assets are shying away from the long-term bonds. Yet another slide, because many of the investors kept on asking us to just what is the status of cryptocurrency. 78% of the total Bitcoin units have not been transacted in past 6 months. Right. And again, by the side, we have just shown a kind of a picture which talks about the crypto's market capitalization, which was hovering at $1 trillion, which has just come down to $833 billion by the end of 2022. So that shows us what kind of call you need to take on cryptos. And again, many of them have been asking about gold. Gold is a real savior during crisis. And again, actually just gold and probably just US Fed rates have got a inverse kind of relationship. So we hope that the Fed rates will settle down by mid of 2024. So that gives you a clear clarity as to just what should be a call on gold. Gold or silver, you can just invest if maybe a portion of your assets to just safeguard your portfolio. And again, actually, this long-term story in India is very clearly known. We urge investors to just take a balanced approach, because if you ask me what is the way forward, I'm very clear. Just take a balanced approach towards your investments, and actually just because the valuations are being stretched out, others are beat, and in the short term, the fear and the global slowdown will definitely just dampen the sentiments, and maybe in the longer run stay just very, very optimistic, and then actually just look at long term and just make investments in the equity markets in India in a staggered way, and again look at bond funds and start investing in bonds. And already just we kept on insisting even a couple of months back or even 6 months back, stating that start investing in bond funds because the rates have gone up, which makes it as a compelling option. And probably the interest rates in India may go stable, and there can be a marginal hike if the inflation doesn't settle down. So the relative performance of assets is a very, very fundamental way to judge a market condition. You could compare the Sensex or Nifty values to the past, and then you can just look at your kind of profit growth. It's important to rebalance your portfolio so that you have the appropriate mix based on your goals and the risk profile. Having the right expectations, maintaining discipline in the investment approach, and being patient can take you far in your investing journey in India. And be ready for the roller coaster ride, because when the global markets are very choppy, you can't expect Indian markets to be very stable. And also just we can't comment so much on the inflation and the interest rates that these are. But only thing is start investing in the bond markets. In case you have not started early, start investing in equity markets in a staggered way. Equity markets as well as in the equity mutual funds in a staggered way, because this is going to be a very historical period and a lot of money is to be made in the markets. And be ready for the roller coaster ride. Maybe in the systematic way, you will end up making creating more units, and as such actually just invest regularly. And this is a podcast as well as the YouTube from cPROFIT, and let's get social. Please follow us, like and share cPROFIT's social media pages to be regularly updated. And with this, thank you so much for joining us, and have a great year, have a great day as well. Thank you.